Managerial accounting reports are like the navigational tools of a ship sailing through the unpredictable waters of the business world. They don't just help you understand where you are, they guide you on where you need to go. Unlike financial accounting, which is like a report card for external stakeholders, think investors, creditors, and regulators, managerial accounting is all about the internal crew. It's customized, flexible, and designed to help business leaders make informed decisions that can steer their companies toward success. Let's break it down. At its core, managerial accounting is about generating timely and relevant information that helps management plan, control, and make strategic decisions. Whether it's figuring out how to allocate resources for a new project, analyzing the profitability of different business units, or planning future expenditures, managerial accounting is the backbone of effective decision-making. It's the secret sauce that allows companies to adapt to market changes, maximize profitability, and achieve long-term growth objectives. Now, you might wonder, how does this all work? Well, the beauty of managerial accounting lies in its ability to translate complex financial data into actionable insights. Imagine you're a business leader looking to set a budget for the upcoming year. You need to know where your money is going, how much you can afford to spend, and what areas might need more financial support. This is where budget reports come into play. Budget reports are essentially financial blueprints for a business. They outline the estimated revenue, costs, and allocations for various departments over a specific time frame, be it monthly, quarterly, or annually. Think of them as your financial GPS, setting the parameters within which your business aims to operate. They guide resource allocation, monitor performance, manage cash flow, and ensure that spending aligns with organizational goals. Let's dive a bit deeper into what makes up a budget report. One key component is the cash flow forecast, which provides an estimate of cash inflows and outflows over the budget period. This is crucial for maintaining operational solvency. It tells you when and where you expect to receive money and where you expect to spend it. For instance, if a retailer anticipates a significant cash inflow during the holiday season, they might choose to schedule debt repayments or capital purchases around that time to maximize their financial position. Another important part of budget reports is budget variances. These highlight the differences between projected and actual figures, shedding light on areas that need attention. Positive variances indicate where resources can be reallocated, while negative variances signal the need for cost-cutting or strategy adjustments. Picture this. If your marketing budget was projected to be $50,000 but the actual spending reached $70,000 without a corresponding increase in customer acquisition, it's a clear signal that it's time to revisit your marketing strategies. Then we have capital expenditure budgets, which are plans for acquiring or maintaining long-term assets. These budgets are critical for long-term planning, as they involve significant financial commitments that can impact the company's growth and competitiveness. For example, a manufacturing company might plan to invest in automation technology. The capital expenditure budget would outline the costs, expected return on investment, and how this investment aligns with the company's broader growth strategy. Now, once you've set your budget, how do you evaluate whether you're on track? That's where performance reports come in. These reports serve as an evaluative lens through which organizations assess the efficiency and effectiveness of their operations. They analyze actual data, providing a retrospective view that can inform future strategy. Performance reports are significant for several reasons. They help businesses determine if they're meeting their strategic objectives by evaluating key performance indicators in real time. They also help optimize resources by pinpointing underperforming areas and encouraging a culture of accountability among employees. Regular performance reviews can identify potential risks and bottlenecks before they escalate into larger issues. Now, let's talk about the difference between traditional and modern performance reports. Traditional performance reports often focus on financial metrics like revenue, expenses, and profitability. They're grounded in historical data and are reactive, offering insights into what has already occurred. For example, A retail store might analyze how well a holiday sale performed in terms of revenue and costs, providing a post-mortem event analysis. On the other hand, modern performance reports take a more comprehensive approach. They incorporate both financial and non-financial metrics, utilizing data analytics, machine learning, and predictive modeling. This integration offers a more holistic view and enables proactive decision-making. For instance, a SaaS company might measure customer churn rates, server downtimes, and customer satisfaction scores alongside traditional financial metrics. These non-financial KPIs could provide insights into product quality or customer service effectiveness, which are vital for long-term success. Let's not forget about cost reports, which are specialized documents that dissect a company's expenditures into various categories. These reports analyze direct, indirect, fixed, and variable costs, depending on the organization's needs. While budget reports focus on future financial planning and performance reports assess operational efficiency, cost reports aim to provide a granular understanding of how and where money is spent. Cost reports help management identify inefficiencies that could be eliminated to save money. They allow businesses to price products or services accurately, maximizing profitability. Detailed cost data can indicate whether certain operations align with a company's strategic objectives and whether they warrant the level of investment they're receiving. They form a foundational layer for informed decision-making, feeding into other managerial accounting reports like budget and performance reports. There are several types of cost reports. Standard cost reports compare standard and actual costs based on historical data and forecasts. Job cost reports are tailored for project-based businesses, detailing the costs of each job or project. Activity-based cost reports allocate indirect costs to specific activities, providing a nuanced view of expenditure. And then there are variable and fixed cost reports, which separate costs into those that change with production levels and those that remain constant. But what about those unique situations that don't fit neatly into the standard reports? That's where specialized reports come in. These reports are tailored to address specific business needs, filling the gaps left by traditional reports. For example, feasibility studies evaluate the practicality and viability of a proposed project, incorporating cost, market research, and legal compliance to present a well-rounded view of potential risks and benefits. Ad hoc reports are another type of specialized report created for specific, often unanticipated needs. They address urgent matters or unusual occurrences, like analyzing the financial implications of a sudden supply chain disruption or measuring the impact of a significant promotional event on sales. Inventory reports focus specifically on tracking and managing inventory levels. They provide real-time data that helps optimize inventory turnover rates, reduce holding costs, and minimize stockouts or overstocks. For example, a grocery store chain might use inventory reports to identify perishable items nearing expiration, triggering discount promotions to move these items more quickly and minimize waste. In conclusion, managerial accounting reports are indispensable tools that provide organizations with the data and insights they need to make informed decisions. While financial accounting caters to external stakeholders and is constrained by standardized rules, managerial accounting is designed for internal use. It offers the flexibility that can be tailored to an organization's unique needs. From budget reports that lay the financial groundwork to performance reports that evaluate operational effectiveness, and from cost reports that scrutinize expenditure to specialized reports like feasibility studies and ad hoc reports that cater to unique scenarios, each type of managerial accounting report serves a critical role in an organization's decision-making matrix. In an age where data is the new oil, mastering the art of managerial accounting reporting is not just beneficial, it's essential for survival and growth in a competitive business landscape. Understanding the different types of reports and their specific applications enables managers to optimize resource allocation, refine strategies, and steer their organizations towards sustained success. So, whether you're assessing the profitability of a specific project or contemplating a new market entry backed by a thorough feasibility study. Remember, managerial accounting reports provide the analytical rigor required for effective strategic planning.